Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. Joining me today would be typically Mr. Michael Becker, Governor of the great state of real estate here in Texas, but he's on another due diligence assignment. And the Professor James Eng, he is on spring break with his lovely family down in the northern region of Florida. So hopefully he's having a great time with his three boys and beautiful wife. Don't forget, Rally for the Cause presented by Old Capital Thursday, April 25th. It's at the Chicken and Pickle in Grapevine. That is benefiting City House. City House is one of our Rally for the Cause. We raise $25,000 for a pickleball tournament. And we do this event to raise money and awareness for a charitable organization called City House. Again, 100% of the net proceeds will be donated to City House. So we'd like for you to play with this pickleball. We have 26 teams. I think, Fritz, are you playing in the pickleball tournament?
I will be there. Gotta work on my game.
Better start working on the game. It is the sport of the decade, pickleball. And so we'd love for you to register and become a participant. Go to the oldcapitalconference.com, oldcapitalconference.com, and please register to either join us for pickleball or even watch some of your friends play pickleball for a Rally for the Cause. We'd love for you to be there. Also, do not forget, April the 17th and 18th, we have the DFW Multifamily Field Trip here in the Dallas-Fort Worth area. Again, it's in April 2024. We're sending you an exclusive invitation. This is for new passive investors only who want to understand before they invest in multifamily. So it is a full day of underwriting. It's a full day in the bus going to look at some properties, Class C properties that we've either found or some of your friends have either sold. So we do this as a sponsored field trip. Colliers is sponsoring it. CBRE is sponsoring it. Marcus Millichap, Newmark, GREA, MW Law, Velo, Regions Bank, and SPI are all sponsoring it. This is not just an Old Capital event. So you'll have a chance to meet a lot of the brokers and a lot of the participants in the Dallas-Fort Worth market that kind of will tell you what's going on. So great opportunity not only to learn, but to also meet a lot of the key players in multifamily here in the DFW area. So remember, go on to oldcapitallending.com, and sign up for the DFW Multifamily Field Trip on April 17th and 18th here in the Dallas-Fort Worth area. We'd love to see you. So this is kind of another special podcast where it is a very intimate podcast because I don't know if you've seen it, but I've seen quite a bit in the last, say, 6 months or so, brokers that have been trying to advertise just raw land. And it may be entitled land, or it may be just raw land to build multifamily properties, whether it's in Texas or throughout the United States. So, I wanted to dig a little deeper into what people are doing to think about buying, entitled land that may be good for a 200, 250 unit apartment building. And so that's really been the hot topic that I've seen the last 6 months is a lot of the brokers that have not been selling 10, 15, 20-year-old multifamily properties, but they've been putting the little birdie in your ear that maybe you should be thinking about building a large multifamily property. So I want to kind of talk a little bit about maybe an opportunity out there to actually build an apartment building. We've had this conversation before. It's been a while. So I want to kind of bring in some of the key participants that we do a lot of business with that can talk a little bit about FHA, talk a little bit about conventional financing on construction loans to build the multifamily property. So in the podcast today, we have Fritz Waldvogel from Colliers. He is a key participant with doing lots of FHA 221D4s. And then Mike Bazans, who is the chief underwriter with FHA for Colliers. And then, his eyes take a look at lots of the transactions that go out throughout the United States. And so we're glad that both of you guys are here So Fritz, thanks for being here. Mike, thanks for being here also. We appreciate that. So let's kind of kick off today, just giving people an idea. So you see the advertisement that comes across from a broker that says the land, it may be, I don't know, 7, 8, 9 acres that's available, that's fully entitled by the city. And now they want you to buy the land. And so you, as the potential buyer of the land, or you're thinking, what's the best use for this land? Should I build an industrial warehouse on it? Should I build a retail center on it? Should I build maybe an apartment building? It was zoned as an apartment building. Maybe I should build an apartment building. And so let's kind of talk a little bit about really 2 ways of financing, or maybe 3 ways of financing an apartment building these days. So one is just a conventional loan, going down to the bank and getting a construction loan from the bank. And let's talk a little bit about that. And the second one is the 221D4, which is a new construction loan through FHA. So Fritz, kind of walk us through what you would expect if you were to go down to your local lender and get a conventional construction loan to build a large apartment building.
Sure. Thanks, Paul. Appreciate you having Mike and I on the podcast. Yeah. So as you mentioned, one of the options is you go down to the local bank and get a construction loan. Generally, those loans are recourse. So you will have to have a strong enough balance sheet to support getting a loan through that bank. And secondly, the leverage is going to be slightly lower than an FHA loan, where you're going to be, constrained at maybe 65, 60% of cost, especially given kind of the current banking issues with regional banks who provided a lot of liquidity on these construction loans. They have pulled back to some degree on how much leverage they're going to go in on these deals. So they're usually some sort of mini perm, so maybe a 3 to 5 year term. And so at the end of that term, you're going to be looking to do some sort of takeout, either through one of the agencies, CMBS, life insurance company, or with HUD potentially. And so that is one of the drawbacks of a conventional execution with a bank is a little bit less leverage, and you will have your balance sheet at risk through the construction.
All right. So let's take some notes on exactly what you said. One is instead of, going for higher leverage, it's going to be lower leverage. So you could be anywhere from 60 to 65% with a conventional bank lender, and not all banks are going to want to do new construction on a brand new apartment building out in the middle of, XYZ. And so it's 35 to 40% down. So that's number one. Number two is that when you qualify, it's going to be recourse typically. Even at putting 40% down, the bank wants you to have some skin in the game yourself. They want you to put some significant cash into the deal, and they want you to have a balance sheet that is probably at the loan amount or greater, and then have the ability to have your own cash into the transaction. So if you have maybe 10, 15, 20% of your own money, then you could raise probably the rest, but they want significant equity in your balance sheet into the transaction, because they want to make sure the person who signs that they have skin in the game and skin into the deal itself. So I get that. And then you also talked about that you have to qualify for this transaction. So you have to qualify for the construction loan. And then when you qualify the construction loan, you also probably have to qualify for the takeout at that period of time, because the bank is only going to be doing the construction loan. They're going to be doing it from, 0 month all the way up to say month 24, 36. You may get interest only during that period of time, but then the bank doesn't want to be your permanent lender. They want to be able to make sure that gets off their balance sheet, their portfolio, and that you can go with another lender that may be Fannie Mae, Freddie Mac at that period of time, or maybe FHA at that period of time to do a permanent loan. And the last thing is that where interest rates are right now, again, we're in the middle of April going into May, the prime rate is at 8.5%. And prime rate is what the banks charge their best customers. And so you may be at prime rate plus a half, you may be prime rate plus 1, you may be prime rate minus a half. So it's going to be right around 8%, maybe 7.99, but it's going to be right around 8%. And then also too, probably the biggest thing right now on the lending side of the banking side is you have to bring in deposits. So the bank says, hey, listen, we'll make you a loan with 60%, 65% leverage, but we also want you to bring in 10 to 15% of the loan amount in deposits. because it's our cheapest way of raising capital is having you bring in your savings account, your checking account, not just for the operating account. That's a given, but we also want you to bring in cash from your personal checking account and your personal savings account. And maybe everybody who's associated with this transaction had them build a relationship with the bank and bring in deposits. Fritz, have I missed anything on that one?
No, I think you covered it. As you mentioned, it's just been the conventional bank financing has become a lot more challenging really over the last, call it 12 months, really ever since the issues with Silicon Valley Bank. It's just harder for banks to compete given the current environment.
Yeah, I just got turned down by a bank that's just said our bucket is filled with construction lending. You may have to make 25 or 30 calls or just call us because we kind of know who the banks are who are actually going to lend on these deals. But not all banks want to do brand new construction and put you into the business of being an apartment builder. So, and now there's good things about having a construction loan. Typically, the construction loan doesn't take a long time to get approved. It may take maybe 60 days, may take 80 days, may take 120 days to the point that you start working on your plans to the period of time that they're going to approve the loan. So it is a shorter time frame to close on the deal. So that is probably one of the benefits. And mostly the benefits are you do have a relationship with the lender that in case you do maybe an override that you don't have enough money, that they may be able to extend out and put some additional money into your bucket so you can finish, maybe upgrade something that you forgot to put in your original plans. So there's some flexibility with lenders, and a lot of bankers have done a lot of construction loans, but I will tell you that right now the bucket is filled. And so what I want to bring to your attention really is another way of getting it done. And it may be something that you want to consider when you're thinking about when you get an offer through your email from one of the brokers that says, hey, listen, I have a 7-acre development site that you may want to think about building an apartment building. So let's talk a little bit about the FHA 221D4. And Fritz, just give us a high level, and I'll poke holes at it, and then we'll bring in the expert Mike to kind of tell us
Perfect.
a little bit more about what does it take?
Sure. Yeah, maybe I'll just start off with just some pros. The real benefits of the HUD 221D4 program is it is non-recourse. First, when we're talking about a bank loan, it is non-recourse, which is a huge benefit. It is a 40-year fully amortizing mortgage. So there's no takeout after a couple of years. Once you hit stabilization, you are fixed for 40 years, fully amortizing. And so there's a construction piece, and then it converts to a permanent note at the same interest rate. The other item is that it is a fixed interest rate. I know many of the construction loans that we're seeing through conventional financing is more on the variable rate side. So obviously, with fluctuations with short-term rates, being able to fix your interest rate at a significantly lower rate than what you would get, as you were mentioning earlier, Paul, through a bank called 8%. We're seeing HUD loans through the 221D4 program at about 6% or slightly lower than that, with the treasuries coming down recently. The other benefits I would say is in terms of leverage. You can go up to cut 85% of HUD eligible costs versus, as you mentioned with the banks, that about 65%, so higher leverage. And then in terms of a debt service requirement, there's really two buckets for the loan, the max loan test. One, like I mentioned, the 85% of HUD eligible costs, but also a debt service coverage requirement based on your stabilized pro forma once at stabilization, and that's at 1.16 times percent for debt service coverage, which is significantly lower than what is typical on the permanent market. Call it with Fannie or Freddie at a 1.25 times. So, you're able to get the highest proceeds, the HUD program with 40-year fixed rate term, and it's non-recourse.
All right, some good information. I took some notes here. I just want to make sure I'm saying it correctly. I would really call the FHA 221D4 really a legacy way of financing an apartment building, and it's for new construction, let's say. So it brings the property out of the ground, and then so that's the new construction piece, and then it just modifies or converts over to a permanent loan. So a 40-year fixed rate, fixed amortized. It's a permanent transaction. So it's a construction/perm loan on the deal. It has a decreasing prepayment penalty. So a lot of bank loans, you can get in there and build it. And then you're at the time that you're done, after it's been stabilized, you can sell it. But this is for somebody that's going to own this property for a while. Now, the loan is, say, assumable down the road if somebody wanted to assume it, but you want to use the 221D4 as a permanent solution, not just to buy the land, construct the property, and then flip it to somebody else. You want to really own this deal. And just like Fritz said, 85% leverage deal, and that's the max, non-recourse. So I don't have my hand in your back pocket for your wallet. So it's non-recourse with, of course, with bad boy carve outs too. And you're able to get higher leverage with a lower debt service coverage typically than what a bank is going to be doing this. Again, not everybody can qualify for this loan. I want to put that out there. Not everybody can qualify. And that's why we bring in Mike Bazans to kind of tell us about who FHA is really looking for. And, we talked a little bit about the benefits. We'll talk a little bit about some of the challenges too. But Mike, tell us a little bit about, if you're going to assemble a team to build the property, who do you need on your team?
Great question. And what HUD is really looking for is experience. And they're looking for experience from a variety of parties. Number one, obviously, the development team, the ownership group. And so they want to see that somebody in the ownership group has developed a project of what HUD calls a similar size and scope before. So they'd like to see that someone in the ownership has done what is being proposed before. But equally important, HUD is looking for experience on the design team. So that would be your project architect. They want to see an architecture firm that's developed or that's designed a good amount of multifamily housing before. And very importantly, the general contractor, because at the end of the day, it is your general contractor that is going to be building the project. And so HUD wants to see a general contractor that has not only worked significantly with multifamily housing, but also is able to obtain a payment and performance bond. Because we have a non-recourse transaction, the guarantee during construction is provided in the form of a surety or a payment and performance bond by the general contractor. And then once your project's built, you've got your management agent as well. And so HUD places a lot of emphasis on the group that you choose to ultimately manage your project whether it's a related party management firm or a third party management firm, that there is multifamily experience there. HUD does always ask about previous HUD experience, and you have to do your first HUD deal to obtain previous HUD experience. So it isn't an issue if you have not done a HUD deal before on the development side. If you haven't, we do find it's helpful to select a general contractor, architect, and or management company that has done a HUD deal before, and they're going to make the process much easier for you. And we can talk about that as we go forward. But really, a team that has a lot of experience in building what you are proposing to build goes a long way in the HUD process.
All right. So Colliers and Mike and Fritz, they're the lender in the transaction. So they're the banker in the transaction. They're the ones that are putting the deal together. So the first step is that you need to have a conversation with us to kind of talk a little bit about who is on your team. Because just like Mike had said, let's kind of go through it, is that there's no certification, there's no approval from HUD, whether you have experience, past experience about building a multifamily property. Mike and his team will kind of understand, want to listen to your story, but they may recommend maybe a consultant to come on and partner with you that has previous experience about building that. So you may have to figure out a way how we can bring a consultant in that may have done 5, 10, 15 transactions before. HUD already knows who these people are, and we'll pair you up, or you can be paired up with a consultant. So I do like that. So if you don't have experience, talk with us and maybe we can help you bring in a consultant that's done this numerous times. Second, you have to have a design team or architectural team that maybe has done not just 1 or 2 contracts, been the architect, but they want to see an architectural team that's probably done 10, 15, 20 new construction, ground up new construction, that they provided the architectural drawings and drafts, and that if HUD needs to make some changes, they're flexible with the changes. So they're looking for somebody that has experience, not somebody that did something back 17 years ago or 5 years ago. They want to see real life today on the mat of what is going on in ground up construction for architectural and design. Another piece is the contractor. I can't stress enough that the general contractor, it just can't be a general contractor that used to build single family homes or still builds single family homes and now wants to get into multifamily. And you're looking at them because they have the lowest price to build an apartment building, and they've never maybe done this before, but they get the lowest level of subs to try to get the deal out, just like how they were building some single family homes. You want to find the highest quality general contractor that has gone through the HUD process and figures out who do we have to hire that is the best subs, whether it's the plumbing, the electrical, the mechanical, the roof. They need to find the best people because HUD's going to want to have the best people working on your property. Because there's a thing called Davis-Bacon wages, and we'll talk a little bit about that in a second here too. But you want to have a general contractor that's not done this once or twice with HUD. It hasn't done it once without HUD. You want somebody that has lots and lots of experience of working with HUD. And the last thing what Mike said, I think is absolutely important, is having a management company that manages the property, not only during the construction of the deal, but also is there when the deal is becoming stabilized. You have to have a management company, a third-party management company that has experience in managing HUD properties. Those are the ones that they know how to fill out the forms. They know how to have conversations with HUD. HUD comes to the property and takes a look, making sure that everything is good. Colliers, the lender, comes in, make sure that the property is looking good. You want to have direct conversations with them. And so you don't want to put these people in business. These people have already done 25 or 30 or 40 different HUD finance transactions. You want them on your team too. So it's an assemblage of a team that has HUD experience. Again, all these people don't get certified. There's no award or a medal that they get, but we kind of know who's good and who's bad. And you want to find if you're going to put this amount of money into a transaction, you want to find the good vendors, players, partners that you can make this a very successful venture. Mike, anything more to add with your partners that are coming in right at the beginning?
No, I think you covered it very well. And one of the key things that you mentioned early on is a development consultant. And there are a lot of groups out there that can help you and check the box with that previous experience. They can also help you with some of the HUD due diligence, and we as a lender and you as an advisor to your clients. I mean, we know who those people are, and we can make those introductions because that is super important as you're working through the process.
Fritz, take us through. So let's see, the land's available for sale. The group wants to buy it. They've kind of put together their team. They got somebody that has FHA experience as a development consultant. They have a contractor that has FHA experience. They have a architect that has FHA experience, and they're talking to a management company that has FHA management experience and managing the property. What are we going to come up with next? I mean, from the borrower, do we need a pro forma? What are we looking for directly from the borrower so we can start getting engaged of what Colliers is going to expect?
Yeah. So the first few things are just, information on your teammates, whether that's your general contractor, who you're thinking. It doesn't need to be final at this point, but who you're thinking for general contractor, management agent, architect. We'll need your year one stabilized pro forma, because we'll need to take a look at, okay, what are you thinking for, rents? What are you thinking for expenses? So we can kind of build out a stabilized NOI. And then in terms of who you think the guarantors are going to be on the loan, and any, personal financial statement, resume, schedule, real estate, any sort of experience that you can provide will really allow us to kind of run through our preliminary models, so we can kind of spit out usually a 5 to 6 page spreadsheet of kind of the overview of the underwriting of the transaction. Mike, is there anything I'm forgetting?
No, I think that's exactly right. I mean, what we try to, when we talk about the HUD process and we talk about the HUD underwriting, the easiest way to sort of communicate how the program works and how the execution looks on your deal is reviewing a development pro forma, because that allows us to put together a loan analysis that we can review with you in detail and show you how the different moving pieces come together and how we get to our leverage point. The other thing that's really helpful to see up front for a lender to help us sort of run the traps on the HUD execution is a site plan and how your building sits on the site. You're dealing with federally insured financing, so you do have some, additional environmental review that goes into the HUD process. And, with HUD, environmental isn't just, phase 1 and phase 2. It does have to do with potentially historic preservation, noise. So if you've got railroads nearby, gas and oil pipelines, things like that. So really being able to review a site plan is upfront allows a lender to better understand what is going to go into the transaction and potentially advise on consultants to bring in to help make the process easier.
Great point. Another thing is, Mike, tell us a little bit about the sponsors. I mean, in whether it's a Fannie Mae loan or a bank loan, we always talk about the net worth equal to the loan amount or so of all the sponsors that are in the deal. Tell us what FHA is looking for with net worth, liquidity, things like that.
Sure. So unless your loan is above $125 million, HUD is a little less prescriptive with respect to net worth and liquidity than maybe the agencies are. And I say that in that there is not a stated net worth and liquidity requirement. That being said, a good benchmark is what the agencies require to have, net worth that adds up to the loan amount among all the sponsors and liquidity of 10% or more. What we're really looking for, though, is to show that not only can the sponsorship meet the equity requirement for the transaction, but then is able to fund any shortfalls or deficits that might come during or after lease up. Now, HUD does have reserves built into the program to help with that, but you want to be sure that your combined sponsors aren't spending every dollar they have at the closing table. And so we are looking for strong net worth and liquidity. HUD uses the term adequate or sufficient, but you really want to be sure that there's enough financial strength there. The other thing that HUD really looks at is the strength of the general contractor. And we've mentioned this before, but HUD looks to make sure the general contractor has working capital of 5% of the construction contract amount when adjusting for their current projects, because they want to be sure that the contractor is able to, make materials deposits, pay the subs, make sure that mechanics liens aren't getting filed. And so that goes also to the importance of selecting a very strong and experienced and financially strong general contractor.
Sounds like that HUD is a good option. Now, Fritz, we've got our team put together. We've got our review of the site plan. We've got our sponsors that look good. Walk through with us the timing and what needs to be done. Take me from step 1 to step 7 or so to try to get a loan approved.
Sure. So once we put together our preliminary analysis based on the information that Mike and I just mentioned, and the numbers look good, we feel confident that everything checks out. You're good with the loan amount, the borrower's good with the loan amount. At that point, we can start the process of having a concept meeting with HUD. This is something that HUD does on the front end, which takes us maybe a week or two to review. The information is not much more additional than what we need at the preliminary loan analysis stage. Obviously, just information on your team. And we set up a meeting with HUD to go through kind of the team, the deal. And like I said, that process takes maybe 2 to 4 weeks to get in front of HUD. One thing we do sometimes like, depending on the market, what we like to have for that concept meeting is a market study. So this is something that later on would be required as part of the HUD process. But you go out and we'll hire a third party to come in and take a look at the market, making sure that, in their opinion, that there's plenty of demand for the project. And so, it'll be a long 100-page, document looking at, not just your project, but, all the current projects that are in the queue, whether they're in the, start of construction or not. But if they're permitted, we'll take a look at everything. And that's something that we really find is very beneficial for that concept meeting. Is to be able to show HUD if they have a question on demand, hey, here's a concept meeting, or here's a market study that shows that there is ample demand for this project.
Yeah, just like in the movie where they ask, build it and they will come. When you see a property that's been listed for sale and you want to think about building a large apartment building, you may go down there and take a look around, but you may not know all the other apartment buildings that are going to probably come out of the ground in the next 6 months or a year. And so what the market study does is that gives something in writing. It's usually about 125, 130 pages. And it's done by some of the bigger agencies, whether it's CBRE, JLL. They get assigned this ability to do the market study on behalf of you. And the fee is anywhere from, say, $7,500 to $10,000, but it is invaluable because it really shows who else is getting stuff going on the ground that you would, if you were to build this. Do you have enough demand to satisfy all this inventory? So, build and they will come. Yes, possibly. But if the demand is not there, you don't want to build something that is going to sit vacant for 24, 36 months, and you have to cut rents just to fill your building up. So HUD wants to make sure that there's enough demand for you to build an apartment building. So that HUD market study is absolutely fantastic. And for some reason that HUD turns you down, for some reason, you can always use that market study for the lender, for your bank lender, for them to take a look and see what the opportunity is for supply and demand in that marketplace. Mike, anything more to add to that market study?
No, it's invaluable because it tells you, number one, what the growth in the submarket is. It's going to look particularly at your primary market area and your secondary market area. But then, as you mentioned, it's also going to tell you what projects are proposed. And from the perspective of discussing with HUD, at your concept meeting, there's going to be a HUD appraiser at that meeting. And HUD is also going to reach out to their internal market analysis division. They call it EMAD, for feedback on the project. And so being able to go to HUD with market data showing the proposed demand for the project makes a big difference in that meeting in presenting and discussing with HUD and their appraiser. So it's invaluable for expediting the conversation as well.
All right, Fritz, take us from the concept meeting has been done. Everybody likes what they're seeing. It's just like launching a rocket. There's about 5 people, 10 people around the table. Everyone has thumbs up. Now what happens?
Yeah, so HUD, assuming HUD wants to move forward, they'll issue an invitation letter. And at that point, if we're ready to move forward, we start spending more money in ordering third-party reports. So we'll order, an appraisal, a phase 1 ESA. It's called a hero submission. And then there's an advanced market study that we'll just have to update. But essentially, that's called the pre-application stage, and that takes, call it 60 days or so from start to finish. And that's where we'll get, more due diligence from you, get the updated reports, firm up the underwriting, and then we submit another application called the pre-application into HUD. There's really a 2-stage, process. And then after the pre-application stage, there is a firm application stage, and that's about, call it, what, Mike? 60 to 90 days all in.
It takes essentially the time for the third-party reports and collecting the preliminary due diligence to submit the pre-application. And then once we submit that to HUD, they have 60 days to review and approve and issue an invitation letter.
Yeah. And so there is a process. And, as we were talking about earlier with the difference between bank financing and HUD isn't going to be longer than it takes it to go get a bank loan. Generally, we like to say it's 9 to 12 months is a good parameter. It can be faster, it can be longer, but really it comes down to kind of where you are in the process. Do you have everything finalized with the city? Do you have, your plans and specs? How do your drawings look? So if you really start the HUD process, as you begin, your project, it really doesn't add any additional time, because generally we like to say it's about 120 days from when you have a 90% set of plans and specs. HUD will be ready to close. And so as long as you start that process in the beginning, it really doesn't add a whole lot of time. But if you said, hey, I got all the permits, my drawings are all done, it will take a little bit longer than going to get a bank loan.
Yeah, and that's something that we see a lot of times. People try to go for the bank loan first and then figure out, well, I got to put 35 or 40% down and I don't have the net worth, liquidity. I don't have a lot of these things, and maybe I should look at doing a HUD loan. I actually think you should do it the reverse way. I think you should apply for a HUD loan first and see if you can get the 85% leverage and non-recourse construction and the permanent 40-year loan. And then if that doesn't work, go to try to do a bank loan on that way. I think that's the easier way. So assemble your team first that you think would be good vendors, partners that have HUD, past HUD experience before you start doing a conventional construction loan. So, okay, again, so you've gone through maybe 90 to 120 days. What happens next? Does the loan get approved or denied? At what period of time do we have a firm commitment?
Yeah, so that's at the end, as Mike was mentioning earlier. Once we have that firm application into HUD, they will come out and issue a HUD commitment. And from there, that is at the point where we would lock the interest rate and then start pushing towards closing, which once you lock, it's between, we like to say at least 2 months, about 60 days from when we lock to get to closing. So you do lock the loan closer to the end of the process. And, if you're starting today, I think most people think, 6 to 9 months from now, rates will be lower. So could be a benefit, but that is something that, we do not lock the HUD loans on the front end. It's not until once we have a firm commitment in hand.
I think that's great for today into the environment that we have higher interest rates today. And that we're thinking that in the near future, whether it's 6 months or a year from now, interest rates will be way, way lower in the market itself. So Mike, talk to us a little bit. The loan's approved. We've locked the interest rate. Are we ready to start to turn dirt?
Absolutely. So once we lock the interest rate, we do have to submit closing documents to HUD. And we are working on those closing documents. Our counsel will be working with the Developers Council while HUD's processing that application, with the goal of turning that closing package as soon as we have locked that interest rate. Locking the rate finalizes the mortgage amount, especially in the debt service based loan environment that we're in right now. And so typically we lock the rate, we finalize the closing documents, submit that to HUD. HUD reviews for 30 business days, and then we've got a closing. Once we have the closing, you are off and running. Your contractor is going to start construction within 10 days of that closing, and you're off to the races building the project.
Walk back with me, because we may have not covered this, because the person got a flyer, says the land is worth, we want to sell it for $7 million or whatever that price is for the raw land that's going out there. How do we structure the contract? Do we buy the land first? Can we structure it out for 12 months to when this thing's ready to go? Tell me a little bit about what you've seen in the past, how to take down the land if the loan's not going to be approved for 9 to 12 months.
That is a good question. And what I would say is the ideal situation is that you're able to structure a land contract with your seller that gives you time to close the HUD loan. Ideally, that would be, you would have a 12-month land contract, and perhaps you could structure some sort of earnest money deposits where as you get further along in the process, maybe some of the contingencies go away, or you make a additional earnest money deposit. Obviously, 12 months is a long time for a land contract, but at the same time, that would prevent you from having to come out of pocket and purchase the land prior to the HUD closing. You can take down the land prior to the HUD closing and get reimbursed for the cost of that land to the extent that it's, you have a cost limited mortgage at closing. One unique thing about the HUD programs as compared to a bank loan is HUD will recognize equity in the land. And so HUD will look at the appraised value of the land rather than your acquisition cost for purposes of the cost-based mortgage. So
that's a big deal. That's a big deal for people who don't know that. Mm-hmm. So, if you buy the land, and again, we'll use that $7 million or so. That's a hard cost that you're buying for it. It may or may not be entitled, but usually banks say that we're not going to use the higher value. They now it may be worth $8 or $9 million because now you're going to make it into apartments. They look back, say 2 years, and they will not use the new valuation of the increase of that. So that the banks just will not do it, but HUD will. HUD will use the increased value of whatever it is. Go ahead, Mike.
And so I think, I know we're talking about land contracts and buying land, but if you do have land that you have owned for a long period of time, or if your land seller is willing to be part of your project, with HUD, you can contribute that land as equity for the deal and recognize the value. And that's significant. And we have seen land sellers retain a small part of ownership of HUD insured transactions as well.
So that's used towards your 15 to 20% down. So that's pretty good that you can get some of that appreciation that you are not going to get from the bank. So What else do we need to know, Mike? Keep going.
One thing I think we didn't cover, but we mentioned briefly early on is with the contractor and the requirement for Davis-Bacon wage rates. And with HUD, because it is federally insured financing, HUD does require the contractor to pay their subs Davis-Bacon prevailing wages. Now that, in some markets, that comes at a premium. In DFW particularly, we understand that there's not much, if any, of a Davis-Bacon wage premium. But what's really important with Davis-Bacon is that it does have some additional compliance requirements for the general contractor. And that goes back to selecting a contractor that either, has done a Davis-Bacon project before or has the sort of back office staff that is able to administer the Davis-Bacon wages, because you don't want to have issues on the wage front and you're trying to convert to a permanent loan and you've got issues with the DOL. And sometimes you see that on smaller or contractors that have been more focused on single family home building or sort of smaller commercial building. So really important to select an experienced contractor from that perspective.
All right, Fritz, the loan closes. They start turning dirt in over 10 days. Now things are off to the races. The contractor is starting to build foundations and starting to go vertical over here, and roofs are being put on over here. So typically, how long is the construction term, and is it interest only during that period of time? And then walk through me about a lease up and walk through just some of these details about when you do a HUD loan.
Sure. So yeah, that initial period, the construction period, it is interest only, and it is a set schedule that our closing staff will work with you on really the draw process. But like I mentioned, interest only, and you do draw on those funds as needed. So you're not, say you close on a $10 million mortgage, that $10 million is not funded and you're paying interest on day one. That is drawn throughout the construction period. So at the end of the construction period, we're working on one right now. That period's 21 months. It really fluctuates. It really depends on the size of the project and how long it's going to take to build. And then it converts there's final endorsement, and then it converts to a permanent loan. But the loan, the interest rate does stay the same. Mike, anything to add?
And so the interest only period is the length of your construction contract plus an additional 2 months. And shortly after that, the loan does start amortizing. So a little bit of a unique feature of the HUD loan is that commencement of amortization happens first day of the 4th month after your construction contract ends. But to sort of account for some of that, HUD does have what's called an operating deficit escrow that's funded at closing. And that's an escrow of roughly 6 months of your debt service payments and can be drawn on to fund those operating shortfalls. So, ideal situation, you open your building full. The reality is, unless you're building a low-income housing tax credit project, that's probably not going to happen. So you'll be making principal and interest payments while you are leasing up the project before you've hit break-even occupancy. And so that escrow is there. It's held by the lender, and you can draw on that to make your debt service payments during your lease-up period. And once you're leased up and stabilized, any portion of that escrow you have not used comes back to you. And so, on a successful project with a standard lease-up time period, that escrow is not fully exhausted and does come back to the borrower. HUD also has a working capital escrow that's there to help fund change orders as well as some of your lease-up costs. So we will be escrowing funds at closing that you can draw on when you're setting up your leasing office, you're making your website, you're doing your initial marketing, you're paying commissions to your leasing people. There are funds in escrow for those related costs as well to help you cover those.
Fritz, talk to me a little bit about reporting. So the property is leased up and now it's stabilized. What does the third-party management company have to do for reporting to you, to HUD, or any additional thing you have to put together?
Yeah, so it's going to be, we as Colors Mortgage, being a MAP insured lender, we do service the loans on behalf of HUD as well. So you work with your management team will work with us in terms of reporting requirements. You'll be required to provide, quarterly financials, once it's stabilized, There is one thing with HUD mortgages, you are required to get audited financials. And so that is an additional cost that, some folks are not used to. If you do not have not done a HUD loan in the past, you'll have to do full audited financials, and that is a cost of probably $7,000 to $10,000 a year of additional cost to do that audit. But otherwise, it'll operate if you've done agency loans in the past, like say Fannie and Freddie, it'll feel similar to that experience as you work with the MAP insured lenders staff, not HUD.
All right, talk to me a little bit more about MIP. A lot of people don't know what MIP stands for. And right now, in a new construction deal, you're always trying to be energy efficient on these properties. So if the property is not energy efficient, what's the cost there? It's energy efficient. What's the cost there? And how's that calculated?
Yeah, so HUD it's in addition to your interest rate, it's separate. So MIP stands for mortgage insurance premium. Essentially, it's HUD puts those funds aside for any losses in their portfolio. But essentially on these new construction projects, we are seeing most folks, I would say the majority of all projects, qualify for green financing. And so if you do qualify for green, your MIP is only 25 basis points, versus if you did just a traditional market rate project, it would be 65 basis points. So it's 40 basis points different. And especially if you have a debt service constrained mortgage, MIP is included in that debt service calculation. And so it allows for significantly more proceeds. And a lot of the green, to qualify for green, are going to be pretty standard items that you would do on a new construction build anyway. So it's really not an additional cost. One of the reasons that it is, we do calculate the MIP separate from your note rate on the mortgage, is that it doesn't amortize with the note rate. So it's just the percentage of the outstanding balance. So as you pay down the loan through your loan term, it's called on a green project, it's 25 basis points, but as your loan gets paid down, it's 25 basis points on a lower amount.
And then also too, if interest rates come down, talk to me a little bit about, let's say we had an interest rate right now, we locked in at 6%, but now interest rates are now a lot lower than that. Do we have to refinance the entire $30 million transaction, or what happens there?
No, HUD has a program called a mortgage modification. And so you can go back to your existing lender and lower your note rate. So the general structure on a HUD prepayment structure is called a step down. So there's no yield maintenance, starts at 10% in year one and then fluctuates down 1% per year to zero in year 10. So there is no yield maintenance. So one thing that HUD will do is called a mortgage modification. And you can go in to your existing lender and say it for legal costs, call it $10,000 to $20,000 of cost to do a mortgage modification, and HUD will lower your interest rate. However, what HUD will do is they will bake in, if there is some prepayment still remaining, into that cost. So say if market interest rate would be 4%, you have 6%, you may have a higher interest rate as HUD bakes in some of those prepayment costs. But in terms of out-of-pocket costs, we have seen it very beneficial, going back maybe 3 or 4 years ago on some HUD mortgages that we did, we closed D4s in 2017, 2018. By the time they, became stabilized, many of those deals immediately, once they became stabilized, converted and did a mortgage modification very immediately and were able to lower their interest rates for the permanent phase. So it is a very attractive way of lowering your interest rate without having to deal with, yield maintenance costs.
And that's what you're seeing right now. A lot of transactions that are closing right now are assumptions of a lot of FHA HUD loans, because they were at 3.5, 3.45 a couple of years ago. And if interest rates come back down, I would tell you, try to do a mortgage modification to try to get that lower rate and capture that. So if interest rates ever go up in the future, you'll have a competitive advantage on that one. All right, let's finish this up here. Let's just kind of go around the table. What did we miss, Mike, that you think is important? Then Fritz, what did we miss that you think is important too? So Mike?
I think we covered a lot of the basics. I mean, I come from a perspective of working on FHA transactions, but I think from the standpoint of construction financing, having a construction to permanent loan takes out your refinance risk, it takes out your conversion risk, and on the HUD program, you're locking the upper bound of your interest rate because of the modification program that we just discussed. And so, if you're looking for long-term financing, the D4 is really a great option. And what's important is to bring in your team and bring in a lender early on in the process, because, we did talk about a timeline. The earlier a lender can get started and the earlier you can approach HUD at a concept meeting, the less time the HUD process adds, if any, to your development timeline. Because if you can start early and begin, and as you're working on your plans and your design and layering in the design review that we as a lender have to do, the HUD process can be very seamless as you're working through that. If you decide to do HUD when you're ready to close in 30 days, that's where HUD is going to add a little bit of time. So start early, ask questions, and bring in a very experienced team from the start.
Great information. Fritz, last words?
Yeah, no, I think we covered a lot of it. I mean, I think really the benefit of the HUD program is, HUD is here to lend in all market cycles, very programmatic, in terms of the debt service requirements and the loan to cost requirements. And so in times of stress, as we talked about earlier, that we are in right now in the capital market space, in the banking space, HUD is a great alternative. And our teams are really, really busy. We're looking at a lot of deals because I think the HUD program is in this environment especially very attractive.
Yeah, it certainly is. And make sure that you give us a call here at Old Capital, and we'll put you in contact with these fine folks that are experts in the construction and permanent financing through a HUD program. So again, from the team at Colliers, Mike Bizans, thank you very much for spending some time with us. Fritz Vogel, always a pleasure. And I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.